Hello, it's a lovely good evening from here, and hope that each one of you are absolutely fine and in a fine state of health. So now coming back to the business end, actually what we are supposed to start in this particular session, as you can see, valuation of goodwill. So this is the topic which we have decided to start in this particular session. Valuation of goodwill is a very peculiar chapter in the sense is that under it we are not going to prepare any accounts, isn't it or not? And good thing about this particular chapter is that most of you have been in touch with this particular chapter right from the what we call beginning of your accounting journey. In spite of that, actually this chapter, as I just told you, has especially at this particular level has its own peculiarity, and one peculiarity is that it doesn't require any what we call preparation of the accounts. Here we are simply not working as an accountant. Here we are working almost from the perspective of a valuer rather than an accountant, as I just said. So whenever you are going to actually study goodwill, so the first thing is that you need to actually erase out the tag of accountant and you presume yourself as the what we call valuer, as I said, rather than an accountant. So this chapter has great peculiarity, uniqueness in the sense that one thing is of course quite sure, under it we are not supposed to prepare any accounts. And here in this particular chapter, since we are dealing up with the valuation, and valuation is something which is very, very subjective, it depends upon the what we call need and the situations and the circumstances. So quite obviously that means the value could differ in the eyes of different person and the different valuers. Just to take an example, you presume yourself, you have been left what we call lurching in a what we call desert. You know the meaning of desert very well, correct? So you have been left out lurching over there since last 4 days and you haven't had what we call any water. Just imagine for a while, suddenly a person comes down over there and he has got so many water bottles. And now you simply begs him to deliver one what we call water. At that time, I am very sure, if he would have demanded even 10 lakh rupees, you would have had given him. Are you getting my point or not? Because the value of water at that moment is so high that even you would have readily what we call agreed to get imparted with all the gold in case if you would have carried along with you. That is what my point is. You must understand very important thing, and which most of us sometimes tend to actually skip, that value depends upon need, and it is the need which decides the value of the goodwill of a particular thing. Is it clear to you or not? So that is when I said peculiarity and the uniqueness about this particular chapter. So here we have to catch up the things in the sense that we are working almost as a valuer rather than an accountant, and value always differs according to the need of the person. So that is the reason actually under this particular chapter we would find actually there are so many alternatives, so many presumptions, so many subjectivity that one cannot simply what we call draw out a hard and fast rule of solving a particular question. Because when we value the things, we have our own presumptions, our own needs, our own requirement, and the situations are different, circumstances are different. So that gives rise to what we call lots of differences. So that is the reason under this particular chapter we will also see later on lot of presumptions are taken into account for valuing the goodwill. So that is the reason actually this chapter has got its own peculiarity, which was not the case in the chapters which we did so far hitherto. So as you know, valuation of goodwill actually, need for goodwill arises actually generally, as you have seen actually, especially in case of partnership, whensoever there used to be a change in profit sharing ratio, partner used to value the goodwill. If the old partner, in case actually a particular partner is admitted, even then you used to actually value the goodwill. If a particular partner used to retire, you used to value the goodwill. Likewise, even if a partner would have died, you used to value the goodwill. And in case of companies, generally the valuation of goodwill is needed when two business houses merge, or when a particular company sells its business to other company, and sometime when government nationalizes an entity, in order to decide the compensation, the valuation of goodwill is needed. No doubt about that. Goodwill is needed on so many occasions, so many circumstances. In fact, that is the reason actually that valuation of goodwill will never leave you. It will almost run after you, almost like your own shadow. Even though, as I said, this particular chapter has got its own peculiarity, but it has got significant influence, as we will see later on, because as I just mentioned, often we need to actually value the goodwill. Problem is this. Anyway, even though this chapter has got its own peculiarity, and this chapter is little bit subjective, lot of presumptions are needed, lot of what we call permutations and computations are needed. So that is the reason in this particular chapter we will see actually we are going to solve the question with a set of presumptions, and that sometime actually give rise to the differences in the answer, but that should not bother you at the same time. But because we have to conduct the class, we simply cannot allow all the 500 students sitting down here to have his own set of what we call presumption. While solving the question, we will simply tell you that what sort of assumption you are supposed to take over here, at least in the class. Now, at least in the examination, then you can take a different assumption. That's a different matter. Because as I said, we have to conduct the class so that our answers and solutions are absolutely same. So that is the reason, first of all, we will make some rules and regulations that you have to follow this assumption here, you have to follow this assumption here. So that we can have a same solution at least in the class, but at the same time we are not stopping you, and neither we are what we call asking you to not to use a different assumption and a different way and a different approach in the examination, because so many alternatives, so many approaches and so many avenues are available in this particular chapter, because it is a subjective one. So we cannot simply stop anyone being what we call a little bit more lethargic with what we call adoption of a particular technique. So you have the right, you have the freedom, you have the liberty to use any alternative, but at the same time there are some rules which you will have to follow. So we start this particular chapter first of all with the meaning of the goodwill. Now, to be very honest with you, goodwill, if I am going to ask you, the most of the time when we get the answer is that goodwill is the excess earning capacity of a business, because this is what is written in the books, and this is what we have been studying since what we call almost what we call right from, as I said, the inception of our journey as far as accounts is concerned. No doubt about that, goodwill is the excess earnings of a business in simple words. For example, there are 5 business houses and they have a similar capital employed, presuming all these business houses have similar capital employed, and this business house has higher profits in comparison to other businesses. So we may say that this business house is having what we call goodwill to the extent of its excess earning over the earnings of the other businesses. Generally, we mean by goodwill the excess earning capacity of a business house, but that is, to be very honest with you, an old concept of goodwill. In present times, goodwill simply means future earning capacity of a business. Because if I am going to take over a particular business today, the goodwill of that business will have no significance if that particular business will not earn any profit. Could you imagine a particular business is earning goodwill without any profits? And we will see later on, whensoever we are supposed to value the goodwill, we are supposed to compute the profits. So that becomes all the more a greater reason to understand the goodwill in the light of what we call future earning capacity of a business. So you simply make your what we call definition of goodwill very condensed, narrow and confined, in the sense that we are going to simply deal with this particular facet of goodwill. Goodwill simply means future earning capacity of business and nothing more, nothing less. Is it clear to you or not? We are not going to talk about the excess earning capacity or something like that. Correct? Just imagine for a while. Just a moment ago I said that this business house is earning profits higher in comparison to other businesses. Even when I am saying that this business house is earning higher profits, and suppose tomorrow I am going to take up this particular business, the first thing which I am going to do is to compute the future earnings of this particular business. Then only I will be able to compute the amount of the goodwill. So that is the reason why I am simply telling that goodwill is nothing but it is the future earning capacity of the business. Is it clear to you or not? So we are not going to actually delve very deeply into the definition part, because goodwill valuation ultimately is associated and connected with what we call calculation of future earning profits. So that is the reason I am saying so, that as far as valuation of goodwill is concerned, that deals up with calculation of future earning capacity. So now we move over to the practical part as far as this particular chapter is concerned. No doubt this particular chapter is quite formidable and significant from the examination point of view. So we start the proceedings now. As far as valuation of goodwill is concerned, you know better than I actually that there are 3-4 important what we call methods, and which we have heard a lot about and which we have studied a lot about. You used to do average profit method, super profit method, capitalization method, and annuity method, etc. But at this level, whenever we are going to value the goodwill of a concern or an entity or of a business, the first thing in the valuation of goodwill is we need to know the art of calculating future earning capacity of the business. If I am going to take up the business of a particular concern today, then in order to compute the goodwill, the first step of mine would be to assess the future earning capacity of that particular business, correct? So whenever we are going to value the goodwill, the first step will be, as I just said, calculation of future earning capacity of that business, and in accounting jargon and language, that is known as calculation of future maintainable profits. So first thing, as I said first, so first of all we need to know the calculation of future earning capacity. Calculation of future earning capacity, but in accounting jargon we would say future maintainable profits. Future maintainable profits. Future maintainable profits. Future maintainable profits. And in short form, I will simply write FMP. Future maintainable profits. Is it clear to you or not? Whenever you are going to value the goodwill of an entity, the first thing which you are going to do is to compute the future maintainable profit of that particular business house. What we mean by future maintainable profits? It is as simple as that. Just imagine for a while, you have been watching T20 a lot of late. IPL has just started, and most of your time, I am quite sure, must be devoted rather than studies towards IPL. But anyway, suppose a particular team in the first 10 overs have scored at this rate. This is a graph I am drawing, correct? A particular team has scored on an average, let us say, at the rate of 8 runs per over. And I'm talking about in the first 10 overs. Now, I just want to actually know what will be the rate in the next 10 over. Should I believe that that particular team would score at the rate of what we call 8 in the next 10 overs too? Or should I presume that it will score more than 8 runs per over? Or will it score what we call at a rate which is lower than 8? This is future. Are you getting my point or not? This is future. So here the subjectivity would lie. Suppose 3 persons are there now who are estimating the future rate. There might be a chance that in order to assess the future, we will first of all assess their past. If we assess the past and if we find that in the last 3-4 matches, this particular team in the first 10 overs had scored at the rate of 8, but in the next 10 overs, they have scored in the vicinity of 12 to 13 per over. So this will give me an idea that even in this match, they may score actually in the vicinity of 12 to 13. Are you getting my point or not? That is how we track out the future profits. Is it clear to you? But in order to track the future, we need to actually keep a sharp eye on the past performance of that particular entity. Is it clear to you or not? What I am trying to actually put into your mind, that means we are trying to assess the future earning capacity, the future maintainable profits of that particular entity, but we have to dig very hard to their past performance, and from there on we need to actually extract some clues, some symptoms, some evidences which can guide us that what sort of what we call profits that particular what we call entity would earn in future. So that is the reason whenever we compute the future maintainable profits, what we do, we take the past profit first of all. Let us say, as I said in my given, in just a moment ago, as I said in my example, that in the last 4 matches or in the last 5 matches, correct? Similarly, let us say I want to compute the goodwill of a particular business house. And let us say I have decided I am going to take into account the past performance of the last 4 years. In the past 4 years, this business house has earned this much of profit. Year 2, year 3, year 4. Correct? During last 4 years, remember we are talking about the past, 4 years period have already gone by. In the last 4 years, profits of this particular business house is equal to this much. Before I delve and stretch myself further, I would love to have an answer from you. Could you tell me when I said that I am assessing the profits of this business entity, what we mean by profit here? Remember one thing, it is very important for you to understand this particular concept so that you can be escaped of from committing some mistakes. When I say profits here, it means I am talking about the profits which I have computed after having prepared trading account, P&L account and P&L appropriation account. Are you getting my point or not? I am talking about those profits. I am talking about those profits. I am not talking about the trading profit. Trading profits means the profits after having prepared what we call P&L account. After having prepared trading account, we get gross profit, and through P&L we get trading, and finally these are the profit which we derive after having prepared the P&L appropriation account. Is it clear to you or not? So when we say that this business entity has earned this much of profit, that means I am talking about these profits. Is it clear? Now, certainly I find actually profits of the second year are quite low in comparison to the others. Suppose I am purchasing the business of Mr. X, and these profits are of Mr. X, of course of last 4 years. I tell to Mr. X that profits of second year are quite low in comparison to the profits of the other years. So Mr. X tells me that yes, profits of second year are quite what we call low because this year there was an abnormal loss due to fire or theft, whatever you may call it. This year, profits are quite low on margin. The reason is that there was an abnormal loss. He gives me the explanation. And since I am interested in tracking the future performance, I will have to adjust the past in the light of normal circumstances. Are you getting my point? So that is the reason I will eliminate the abnormal losses. Now you tell me, if I am going to eliminate the abnormal losses, profits of this particular year will now rise. It is quite obviously because it is an abnormal loss. Abnormal means if we are going to exercise care and caution, we can stop this loss from taking place in future, isn't it or not? So that is the reason when we, first of all, we are computing, of course, future maintainable profit, but even to compute the future maintainable profit, we shall have to actually, first of all, adjust the past profit in the light of normal circumstances. So if there will be any abnormal circumstances, those abnormal circumstantial profits or losses will have to be eliminated. So that is the reason, in order to eliminate the abnormal losses, what we do, we are going to add back it. So plus abnormal losses. So when we compute future maintainable profit, abnormal losses are added back. So now we can say that all this profit are by keeping into account only the normal circumstances, because abnormal losses have been now erased out. Similarly, there could be some abnormal gains or non-trading incomes. So such abnormal gains or non-trading incomes are eliminated, because the first step is that we want to know how much this particular business earned in the past by keeping into account only the normal circumstances. Is it clear to you or not? That is the reason abnormal profits and abnormal losses will have to be eliminated. In order to eliminate abnormal income or non-trading income, whatever you may like to write, non-trading income. Abnormal income could take place this way around. For example, the product which I am manufacturing, suddenly there is a shortage of this product in the market, and that is the reason why I was able to sell it at a price much higher than the normal selling price. So definitely I would earn some profit, but these profits are abnormal in nature. Similarly, presume that the raw material which I use in manufacturing my product, I am importing from the other country. Now suddenly the government draws the duty out of that. That means there is a duty drawback. So on account of duty drawback, the cost of purchase of raw material will definitely, from my point of view, reduce. Now because the cost of production will reduce, the profit margin will increase. But again, this is an abnormal income. So any income which is due to abnormal circumstances is known as abnormal income. Similarly, there might be some non-trading income. For example, our business house has invested what we call in some other business entity, where from we receive some interest and dividend, and that interest and dividend obviously we have included in our what we call P&L account. So again, this is an income not due to the sale of our product. So this is a non-trading income. So that is the reason when we compute what we call past profit, when I say past profit, indirectly it means, first of all, I am computing adjusted past profit. And what we mean by adjusted past profit, adjusted past profit simply means the profit earned by this business house in the past under normal circumstances, because we are trying to wipe out the what we call abnormal natured or featured profits, correct? So that is the reason here, or abnormal losses will be added back, abnormal income will be subtracted. Now we will get total adjusted profit. This will be known as total adjusted profit. Total adjusted profit. Then we are going to divide it by the number of profits which we have taken into account for our calculation purpose. We have taken 4 years of profit, so I am going to divide it by 4. That is number of years of profit. Number of years of profit, which in this case will be 4. Correct? After dividing it by number of years of profit, what I am going to get now? I am going to get average adjusted profit. Average adjusted profit. Also known as past adjusted profit. Average adjusted profits. And if somebody would ask of you, what is the meaning of average adjusted profits? You should be in a position to simply tell him that past average adjusted profits simply means per year profits earned by this entity in the past, per year profit. That means annual profits earned by this entity in the past under normal circumstances. That is what we mean by average past adjusted profit, simply average adjusted profits, correct? So average adjusted profit means now you have come to the conclusion that on an average how much this entity earned in the past under normal circumstances. But since we are more what we call concerned with the future earning capacity of this particular business, now the next step is that we are going to make some adjustment in this particular years of profit, because we need to actually track down the future, isn't it or not? We are more concerned with the fact that what amount of profit this particular business would earn in future. So after having tracked down the past in a threadbare manner, so we are now going to take into account the future earning capacity. Now, could you tell me actually how we are going to track down the future then? Obviously, after having computed what we call their past earning capacity, now we are interested in future earning capacity, and for the same what we are going to do now is that we are going to actually add the future incomes and we are going to subtract the future expenses. That will give me an idea actually what could be the possible earnings from this particular business unit in future, isn't it or not? So that is the reason actually that after having arrived over this particular step, I will have to make some future adjustment in this particular what we call concept. So here I am going to write plus future adjustments. Here I am going to add future adjustments, plus or minus. There could be plus, it could be minus. So future adjustments will be made. If there is some expectations of future gains, I am going to add it. Future gains. As I said, future gains shall be added and future losses shall be subtracted. Future losses. Sir, could you give us some example? Oh, why not? Suppose I am purchasing your business and I find that in your business you were using more what we call manual techniques, and I am interested in incorporating what we call high profile techniques. So obviously I will have to spend something in future. Are you getting my point or not? Similarly, I might like to have some high profile professional in this particular business, so I will have to spend more on the management fee. So these are my future expenses. So obviously I am going to subtract the future expenses or losses, whatever you may like to call it, isn't it or not? Similarly, there could be some future gains. Future gains in the sense, for example, I am taking over your business and you have kept 4 employees whose salary, annual salary, let us say, comes down to rupees 4 lakh. I'm presuming that when I am going to take over your business, I need not require the services of these 4 men, because I am going to actually adopt a very computer savvy technological state of the craft, what we call technical adoption in my business. On account of that, I need not require the services of these 4 employees. So ultimately it means actually I am saving 4 lakh rupees. Are you getting my point or not? So these are my future savings. So if I will have to track the future in this manner, and that is the reason all the future gains will be added and future losses will have to be subtracted to know actually what amount of profits this particular business would earn in future, correct? So now what I am going to get, that is known as future maintainable profit. Remember one thing, at this particular level, whatever method of goodwill you are going to adopt, which you have studied in your class 11th, in your class 12th, at your BCom level, at your earlier stages of professional courses. But at this particular level, you must understand that whatever method you are going to adopt, actually, you are supposed to compute, first of all, the future maintainable profit, then only you can use what we call any particular specific method to compute the amount of goodwill, correct? Now, after having a discussion with respect to the calculation of future maintainable profit, now we move over to the methods of valuation of goodwill, isn't it or not? Methods of valuation of goodwill. Methods of valuation of goodwill. Methods of valuation of goodwill. Just pay attention over here now. In your, even I have forgotten, in your class 11th or 12th, whatever it was, correct, in your earlier stages of education, you have learned all this method, average profit method, super profit method, and something like capitalization method, isn't it or not? So these are the various broad categories of methods of valuation of goodwill, no doubt about that. Now, for example, in average profit methods, you used to compute the average profits and then you used to multiply it with years of purchase, which could have been 3, 4, 5, depending upon the mutual agreement of the purchasing party and the selling party. This is how you used to compute the what we call goodwill under average profit method. At this level, the method will remain same with the slightest of possible what we call difference. So at this particular stage, when I am going to say that I am going to value the goodwill on the basis of average profit method, so my approach will be like this. Average profit method. In order to assess the goodwill of a particular concern through this particular method, the first step will now become like this. Under the first step, instead of writing average profit, I am going to write future maintainable profit. This is the only difference. And you need not require to blink your eyes like this in utter amazement. It is nothing. It is the same thing. Only thing is that I have substituted the word average profit by future maintainable profit. If you have given a sharp eye to the solution which I just did a while ago, you must have noted that when we compute future maintainable profit, we already take into account the average profit, isn't it or not? So it is similar to average profit with a slight difference that we have made some what we call future adjustments in it. So after having computed future maintainable profit, the next step is very simple. We are going to simply multiply it with years of purchase. Years of purchase. So you are going to multiply it with this one to get what we call the amount of goodwill. Isn't it or not? So simple. Any difference? No difference at all. Only thing is that you should be well aware of how to compute the future maintainable profit. Then there was another method, super profits method, isn't it? So many times you have used super profits method in your earlier phases. Super profits method. Under super profit method, if you remember, in your earlier phases of education, how you used to compute the amount of goodwill, do you remember? I just give you an example just so that you can comprehend the things quite easily. For example, this is the concern of A and B. Messrs. A and B are two partners, we presume. Intentionally, I am taking the case of a partnership, although we are more what we call concerned with companies at this level, just to remind the things of. For example, the capital employed of A and B is 8 lakhs. Correct? We further presume that the A and B deal in computer industry, that means they have a computer line of trade. Their capital employed is 8 lakh and normal rate of industry means their business is of computer manufacturing or selling, whatever you may call it. Correct? So all the business unit, as you know, because economics is better as far as you all are concerned than I actually. So you must have actually studied in your economics that industry is nothing but it is a collection of the firms. So industry rate of return is given, which is 10%. We further presume that actual profits of A and B or average profit, whatever you may like to say, is equal to 1 lakh. And if I ask you to compute the super profits, you can easily compute. For example, first of all, what you are going to do, you are going to take into account the actual profits or the average profit, which happens to be 1 lakh. And then you are going to compute the normal profit, which you have computed million times, isn't it or not? In order to compute the normal profit, what you used to do, you used to multiply your normal rate of return with your capital employed. So capital employed is 8 lakh and normal rate of return is 10%. So that comes to 80. So as you can see that you are able to earn rupees 1 lakh. But other firms in this line of industry will earn only 80,000 because 10% is the normal rate of return. So normal profit means the profit which is usually earned by the other rival firms in the same line of trade. So that is why we are saying that you have superiority as far as earning of profits are concerned. So these are super profits. Now you are going to multiply it with years of purchase to get what we call your goodwill. That is the way you used to compute the amount of goodwill. Even at this particular level, more or less the theme of computing the goodwill under super profits method will remain the same, but as I said, with the slightest possible difference. So what exactly that difference will be, that we are going to discuss now. Under super profits method, instead of taking the average profit, could you tell me actually what should I prefer? Of course. So instead of taking average profit, we'll start off with future maintainable profits. So at this level, that is the reason why I told you initially that whatever method you would love to have to compute the amount of goodwill, you need to be very, very deft. You need to be very, very, as I said, expert in computing the future maintainable profits. Correct? Because without that, you simply cannot proceed. So future maintainable profit, then you are going to actually multiply it with, in fact, you are going to compute the normal profit. Then you will get super profits. Correct? And then finally you are going to multiply it with years of purchase. Step D, you are going to multiply it with years of purchase to get your amount of goodwill. That is how you used to derive goodwill under super profits method. Isn't it or not? Nothing new. Nothing new. And how to compute normal profits? I am writing here. Normal profits means capital employed. Normal profits is equal to capital employed into normal rate of return. And generally the normal rate of return, which is also known as fair rate of return, it is also known as rate of risk return, it is also known as industry rate of return, and that is generally expressed as percentage. So that is the reason in the denominator you will have to mention out 100. But most of these things you are already well aware of, to be very honest with you. Only thing is that so far which we have learned in this particular session is the computation of future maintainable profits, isn't it or not? Now we come to some important facets which we need to have the knowledge of, at least at this particular level. When we started this session, I told you goodwill is a chapter which is not done from the perspective of an accountant. This is done from the perspective of a valuer, and since we are measuring, we are assessing the value of a particular thing, and because the value depends upon the needs and the circumstances, that is why we may not have the same answers. That is the reason I cautioned you that this particular chapter, even though looks very innocent, looks very easy and looks very uncomplicated, but it is not so. Because if 5 different valuer would value the goodwill, there is every chance that all these 5 fellow will have the different answer, because the need from a particular person will always be different from the other person. Are you getting my point or not? As I gave you the example, a person who is in desert, the need for water is much higher and he will be able to churn out a much higher price than a person who is in Delhi. Is it clear to you or not? That is the reason when we value something, obviously the subjectivity will come into the play, and because the subjectivity will come into the play, answers will differ. That is the reason here lots of assumptions are taken into account to solve the questions, but at the same time the assumption should be rational, that should be as far as possible to the point and should strike a proper reasoning. You simply cannot take a blind what we call assumption. Is it clear to you or not? Why I am saying so? For example, sometime in the question we are given that your normal profit should be based upon average capital employed. As you know, in order to compute the normal profits, we need the concept of capital employed, and most of you are very well aware of the concept of capital employed, but in spite of that we are going to have a lot of discussion because it is a very important significant area, because if one commits a mistake down over here, then the entire solution could be wrong, which I do not want you to. So now sometime the question may ask actually that you have to compute the normal profit. Now one person may take simply the capital employed, another person may simply take the average capital employed, somebody else might take what we call terminal capital employed. So there are various concepts available. So that is the reason why I am saying you lot of subjectivity is associated with valuation of goodwill. So we have to be a little bit more careful and cautious when we solve the questions. We have to go through the linings of the question very carefully, whether examiner has given us what we call some hint that we have to follow that particular concept, and if that hint is missing, then we have to be a little bit what we call more broadened and very, very cautious and alert in taking a proper assumption and giving a note to it, so that there is no problem as far as with the solution is concerned. So anyway, we come direct to the point. First of all, we must understand computation of capital employed, because I have already told you we are not doing this chapter from the perspective of an accountant. We are doing this chapter from the perspective of a valuer, correct? So quite obviously, we will not have the same meaning of capital employed with which we are so far accustomed to. For example, in normal accounts, capital employed simply means assets minus liability. Isn't it or not? That is what we generally mean by capital employed in accounts. But in case of goodwill, capital employed is slightly different. So you have to be a little bit, as I said, more what we call alert, more cautious. Now, first of all, I will write the concept of capital employed. Oh my God, what happened? The entire bar has slipped out. See here what happened. Chapter is so peculiar that even pen is declining to write. So you can understand the peculiarity of this particular chapter. Well then, concept of capital employed. Concept of capital employed. So many times I have already told you there is a slight difference between the asset side and asset. This is my entire asset side. But every possible item which is present on the asset side is not an asset, and at this level it doesn't look nice to remind you of that. Isn't it or not? Every item which is present towards the asset side cannot be categorized as an asset, because there are some items which may not fall within the definition of the asset, and these items are known as valueless asset. Valueless asset, VLA. Put it in simple words, it means asset side can be broadly categorized into two parts, assets and valueless assets. Is it clear to you? Are you getting my point or not? Similarly, liability side can be broadly categorized into three parts, capital, reserves and liability. Of course, we are picking up the difference between the assets and the liability. When I am saying so, it means in order to compute the capital employed, we need not require to touch what we call items other than assets and liability. Is it clear to you or not? Because I have already told you, basically the capital employed in accounts means asset less liability. That means whenever we compute Capital employed, we never touch capital reserves and valueless assets. Valueless assets means like preliminary expense, underwriting, commission, discount on issue of shares. These items are present on the asset side sheer because of the fact that they have debit balance. That is the reason why they are written towards the debit side, towards the asset side, because they have got debit balance. So when we will compute the capital employed, generally we will take up all the asset in accounts, but because concept of goodwill is entirely a different panorama, so we have to be a little bit more careful. Of course, we will pick up all the assets. I'm not talking about the valueless assets. We'll pick up all the asset, but even in assets, I will have to be a little bit more careful that non-trading investments will not be taken into account. Non-trading investments will not be taken into account. Non-operating assets will not be taken into account. So what exactly we mean by non-trading investments and non-operating assets? So that is the reason why I cautioned you that we have to be a little bit what we call more cautious, especially when we compute the capital employed. So in order to compute the capital employed, what we are supposed to do, just pay attention down over here. All assets see what I am writing, other than A, non-trading investments. Non-trading investment will not be considered for computing capital employed in the context of goodwill. Correct? Non-trading investment will not be considered. Similarly, we are not going to consider non-operating assets. Non-operating assets. Have you heard this word, non-operating assets? You have gone through this asset, but you haven't paid any attention towards it. The problem is that non-operating assets. Since I have written assets, and assets will never include valueless assets, so no question of considering the valueless assets, correct? We will take into account all assets, as I said, and I will take the revised value in case if it would be given in the question, no doubt again, but the main point here is that how we will come to know that the investments are trading or non-trading. Now just tell me, you have reached at this level, you have cleared your 11th, you have your 12th, your BCom, your earlier stages of education or professional level. So at this level, now you should be aware of this particular fact. Now suppose this is the balance sheet of a particular company and I have written here investment, because most of the time investment is written this way around only. Isn't it or not? If I am going to scan the balance sheet of a particular concern, did I ever come to know that investment is given this way, trading, non-trading? Investment is never given what we call this way around. So how I am going to categorize this particular investment either as what we call trading or as non-trading? So could you give me some inputs in it? Suppose if I have given here in a balance sheet to you and I am going to ask a very simple question. Is the investment in the balance sheet is trading or non-trading? How you are going to demarcate that? So it's a very simple fact. Try to understand this way. First of all, you should know that investment will never be given in an explained manner. In balance sheet will simply tell you investments. But how you are going to find out that it is a trading or non-trading one? Pay attention. If it is written investments and say amount is written 10 lakh, 20 lakh, whatever it is, you will have to always presume it as non-trading. What we mean by non-trading investment? Non-trading investment, but first of all, what we mean by investment? Investment means the funds of your business have been actually invested somewhere else. That means those funds are not being used by your own business. Those funds are being used by some other entity, and in return of that, those entities are giving you some return, fetching you some return in the form of some interest or dividend. So investments are always non-trading without an iota of doubt. It means if investment would be given in the balance sheet in this particular manner, you will never ever take the investment while computing the capital employed. Is it clear to you or not? Is it clear to you or not? Still the answers are not flashed. Yes, now Patiala has given me, Patiala are quite fast actually giving me the answer. Now I am receiving the answer from Jaipur. Yes, now Surat, Mumbai. Yes. So you should be very well aware of this particular fact that investment whenever will be written in the balance sheet, it will always be non-trading. That means you are not going to pick up the investment while computing the concept of capital employed in case of goodwill. Now, just have a look over here. Suppose in the balance sheet investment is written this way. Investments, and in the bracket it is written for replacement of plant and machinery. For replacement of plant and machinery. This further information is also given to you this time. So this time you will have to categorize the investment as trading, because even though the funds have been let out somewhere else and somebody else is using those funds, but ultimately you are going to use those funds in the sense because you are doing this investment for the purpose of replacing an asset for your own business. So this time the investment will be considered as trading. So this particular point is very, very formidable and significant one. That is why time and again I am stressing upon this particular fact that you have to be very, very careful regarding this. So you need to know the art of classifying the investment as trading or non-trading. So whenever in the balance sheet the investment will mention in the bracket that it is meant for replacement of a particular asset or it is meant for redemption of debenture, that means it is meant for something which is associated with an activity related to your business. In that particular case, you will have to categorize the investment as trading, and trading investment are considered for computing the valuation of goodwill. Is it clear to you or not? Now could you tell me the third option? I give you another option. Say balance sheet has given this way: investment in 6% government bonds. Investment in 6% government bonds. Could you classify it as trading or non-trading? Let me actually see who gives the answer first. The first answer is from Jaipur. Jaipur is stating this time, sir, we are going to take it as trading. Unfortunately, this is an incorrect answer. Surat again says it is a trading. Again, it's an incorrect answer. My dear friend, you need to understand that I have written 6% government bonds. So, nowhere it is mentioned that these investments are meant for financing your business activity. It is not mentioned anywhere. So if it is not mentioned anywhere, you are going to take it as a non-trading investment. It is not a trading investment. It must be mentioned in bracket very specifically and in a very crystal clear manner that investment is either for replacement of an asset or for redemption of debenture or to finance some business activity relating to your business. Then only you have the liberty to categorize it as a trading one. Is it clear to you or not? So it will again be what we call considered as non-trading investment. So that is the reason I was telling that even though you have gone through this particular chapter so many times in life and your earlier phases of education, at this level you need to be very, very deft and very, very careful, especially with respect to some tricky items. So investment is one among them. So while computing the capital employed, we need to of course take into account all the assets, but now you have come to know that non-trading investments are excluded. But important is that you need to know the art of categorizing the investment into trading and non-trading. And non-operating asset. What are non-operating asset? You must have seen sometime it is written in the question capital work in progress. Now if something is in work in progress, do you expect it to use for financing or for doing any business activity? For example, a building is still under construction or something is still under construction. Since it is not yet completed, I cannot use it. So that is the reason assets such as work in progress, capital work in progress are considered as non-operating asset. Similarly, if you have purchased some plot of land for the purpose of not using in your business, rather for what we call disposing it off at a later time. So even in that particular case, that particular asset, howsoever bigger it might be, it will not be considered as an asset, it will be considered as non-operating asset. Are you getting my point? So these assets will not be taken into account for computing the assets. So all assets will be taken into account, non-trading investment will be left out. Any item, work in progress, capital work in progress, such assets which are meant for disposal are non-operating assets, and you are not going to consider them for computing the capital employed. Then you are going to subtract all your liabilities. All your liabilities will be subtracted. Now, of course, you have reached the computation of capital employed. But the story doesn't end here. I have already told you we are dealing with a topic which is very, very subjective. So we need to know the every facet and every possible alternative. Sometime question might ask, might not ask. But the problem is that if the question asks, then what will happen? We cannot bank upon this particular theme that question will not ask. We have to be very, very what we call pessimistic and optimistic, both in the sense that question might ask. So if question states that your normal profit should be based upon average capital employed, so what will you do if you are still unaware of what we call concept of average capital employed? So what is average capital employed then? Now, if the question states so, in that particular case, in order to compute your normal profits, you will have to multiply your average capital employed with your normal rate of return to get the amount of normal profits, correct? So, concept of average capital employed. Concept of average capital employed. Concept of average capital employed, correct? Concept of average capital employed. Average capital employed can be computed very easily if I have got opening capital employed. If I have opening capital employed, correct? And closing capital employed, then there is no problem. I can simply take the average of these two to get my average capital employed. No problem at all. But the problem is that the examiner and the questioner will never be so benevolent to give you such a deep and vast information so that easily on a plate you can compute the opening capital employed and closing capital employed. But before that, you must understand that whenever we use the word capital employed, it always means closing capital employed, because generally we take the closing figure, that is the balance sheet figures. So whenever we say capital employed, generally we mean by it closing capital. Now, if the opening balance sheet is also furnished to you, in that particular case, the problem will not arise and you will easily what we call compute, as I said, the opening capital employed. But the problem is that, as I said, intentionally the questioner will never ever give you such a deep information so that you can easily what we call compute the opening capital employed. Indirectly, it means that even though it is a very simple method, we can never ever be able to use this. Sir, if we cannot able to use it, why did you wrote it? Because without having a look over the night, we can never ever understand the meaning of day. Are you getting my point or not? So, obviously, this can be used if the information is there, but unfortunately, the information will not be over there. So, we cannot use, correct, this particular way or approach of computing the capital employed. So, in that particular case, what we do, we take the help of this method. Closing capital employed, minus 1/2 of minus 1/2 of future maintainable profit. Through this particular method, we can get this answer. Just pay attention here. You might be wondering, sir, both these two concepts are looking very, very dissimilar. So how can we get the same answer? Just have a look over here. Suppose my opening capital employed is 100 and my closing capital employed is 400. Suppose my opening capital employed is 100, closing happens to be 400, and I ask you to give me the figure of average capital employed, and within a flick of second you will be able to deliver me the answer. You will simply add the opening capital, you will simply add the closing capital, and we will divide it, and you are going to tell me, sir, this is the answer 250, and I will take it. No doubt about that. This is my average capital employed. But the problem is that if I ask you to compute through this method, how will you do so? See here, 250 was the answer. Please don't let it escape out of your memory. Suppose my opening capital happens to be 100 and closing is 400. Obviously, it means that my business has earned a profit of 300 during the entire year, isn't it or not? Why I am having such late answers? If you are not going to actually converse with me, then sometime it becomes very difficult to take the classes on satellite. So please let me know quickly, quick and fast. You have been given the SAS facility, so you should be in a position to deliver the answer. Now I am getting the answer. Yes. So if my opening capital is 100 and closing capital is 400, obviously my business house has earned a profit of 300. Can't it be concluded or not? Of course it is. So this is my profit. Now my closing capital employed is 400, and 1/2 of 300 will be equal to 150. Again the answer is 250. That's the black magic, isn't it or not? These two concepts fall apart, but in spite of that you found out that the answer is absolutely same. Closing capital is 400 and 1/2 of profit 150. You subtract from 400, you are going to get 250. So you can see that both the methods are delivering us the same answer. So we will have to use what we call this particular approach in the question. The reason being is that opening capital employed will never ever be given to us. In case if it is given, then what we call it in English, icing on the cake. If it is given, that's fine. If it is not given, no problem, because we are aware of what we call computing from another alternative, isn't it or not? So now the point here is that problem arises when question will not at all mention anything that how your normal profit should be based upon. So here the problem arises in the sense that somebody would take what we call normal profit on the basis of capital employed, somebody else will take it normal profit on the basis of average capital employed. That's what I told you, isn't it or not? So in the class, what we are going to do, unless and until the question would specify that normal profit should be based upon what we call your average capital employed, till up to that point, we are simply going to base our normal profits on what we call capital employed. If the question is specifically is very clear, then we don't have any problem. We will use that way around. Is it clear to you or not? This is the rule which we are going to adopt in our sessions. But I have given you complete freedom and liberty to use any alternative in the examination, but at the same time you have to be careful to give the proper notes and the assumptions. Correct? So after having completed till up to this particular point of time, now we move over to the last method, that is known as capitalization, and you have heard this word a lot. Capitalization method. So often in your, as I keep on saying, earlier phases, you have gone through this method. You used to compute goodwill this way. For example, this is the business house of A and B, and their capital employed is 8 lakh. Normal rate of return is 10%. Correct? And we further presume that actual profits earned by A and B is equal to 1 lakh. And if I ask you to compute what we call goodwill through capitalization method, How will you do so? First of all, what you are going to do, you are going to compute the capitalized value. When we say capitalized value, what does it mean? Capitalized value means market value of your firm's capital. Even the capital has market value. For example, there is a business of mine where I have invested 40 lakh rupees. And after 10 years, do you think actually I am going to dispose of my business for 40 lakh? No, not at all. Especially a person of my stature is not going to dispose it of what we call 40 lakh. Definitely I would find that the market value of my capital is much more which I invested 10 years ago. So even the capital has its market value. Now the question arises how the market value of capital is found out. So when we say capitalized value, it means you are finding out the market value of your capital. Is it clear to you? And in order to find out the market value of capital, what you do? You simply take the average or actual profits of your business and you simply divide it by normal rate of return. For example, as I just said, that presuming that your business is having a profit of 1 lakh, correct, in real terms, and normal rate of return is 10%, how much it will be? It will be equal to 10 lakhs. What does this 10 lakhs states? This 10 lakh states that even though your capital employed actually is 8 lakh, but it commands a market value of 10 lakhs. You didn't understand it? Well, just pay attention. For example, 10% normal rate of return is there. What does it mean? It means in the capital market or in this market, if other firms employ a capital of 100, profits earned by them is 10. That is what we mean by normal rate of return. Put it in other words, it means in order to earn a profit of 10 in this market, normally capital employed is 100. Now if I ask you a very simple question, if my profit is 1 lakh, how much capital you would need to earn rupees 1 lakh worth of profits? So what will be the answer? Answer will be 1 lakh into 100 by 10. It means you require 10 lakh worth of capital to earn the same amount of profit of rupees 1 lakh which is earned by me by employing only 8 lakhs. Are you getting my point or not? I have invested 8 lakh. I am earning 1 lakh. You are supposed to invest 10 lakh to get a 1 lakh amount of profits. Quite obviously, my 8 lakh is equal to 10 lakh of yours. This is the market value of my capital. Is it clear to you? That is what we mean by capitalized value. Just cramming the formula will not help you. You need to understand the proper thorough reasoning behind that to understand the real actual factual meaning of that. Is it clear to you? So when we say capitalized value, and so often you have heard this word, so often you have actually gone through this word, so often in your class 11, 12, in your professional courses you have gone through this. But now it should be absolutely crystal clear to you what exactly we mean by what we call capitalized value. So capitalized value means the amount of capital which would be required by other rival firms to acquire and attain the same amount of profits which are being earned by your firm. So it will determine the market value of the capital of your firm, correct? So a story is like this, that you have invested 8 lakhs, you are earning 1 lakh, other rival firms will have to what we call put in 1 lakh, and this difference of capital is nothing but your goodwill. And because the goodwill is based upon the value of the capital, it is known as capitalization method. So under capitalization method, in order to compute the goodwill, of course we need to compute the capitalized value first, but here in order to compute the capitalized value, what we need? In order to compute the capitalized value actually, instead of average profit, we shall require future maintainable profit. That's the only difference. So we will take a future maintainable profit. We will simply divide it by normal rate of return. It will tell us the market value of the capital, and then we are going to subtract from here actual capital employed, or simply actual capital value, whatever you may like to say. The difference of these two delivers us goodwill. Either you can compute this way, or you can simply multiply your super profits by your normal rate of return. You will get the same answer. You will get the same answer. Correct? You will get the same answer. Either what we call, you adopt 3 steps, or you simply go through this particular step. So this is how you are supposed to compute the goodwill as far as valuation of goodwill is concerned. So far what we have learned in this particular session, we have gone through the intricacies, we have talked a lot about the future maintainable profits, and more significantly we have talked about this particular fact that this particular chapter is very, very peculiar, very, very unique in the sense, because here we are not supposed to prepare any accounts, and we have to take the help of lots of presumptions and assumptions, and accordingly we have to move. An important and significant point is that we are dealing up with the valuation. That means we are working from the perspective of a valuer, and we have to be careful that the values could be different. So on such note, I am going to finish up this particular session. I am going to hold down a meeting with you very soon, shortly. So till then, it's a lovely goodbye from here in Delhi.